And we're still at a gold price now at 1,000, I think $838 an ounce, even though energy prices are up a lot for a lot of these gold miners. If you're a low cost gold miner, you're still making a good profit margin. Some of these gold mining assets, the producing gold miners, we've started to see some mergers and acquisitions. The mid-tier, the lower cost mid-tier gold miners are being targeted for acquisition. And the royalty companies, the larger ones, are just minting free cash flow right now. So I think we're going to see a mergers and acquisition boom in the next 6, 12, maybe even 18 months, perhaps sooner than that. I mean, I've been hearing buzz from smaller mining companies that they're already getting potential like negotiations for acquisitions in the not too distant future.
Yeah, you follow closer than me, so I wouldn't be surprised to see that. And one thing to make note of is that partly what your assessment of the gold industry is will partially depend on energy assessment, because if energy is going up along with gold over a multi-year period, generally the royalty companies are very well positioned for that because they basically don't have to worry about the expenses and they get the upside from the higher gold price. Whereas miners, their expense side does get squeezed. But of course, their revenue also does pretty well. So if someone has a specific thesis where they expect gold to do better than energy, the miners could be very interesting because obviously you get them for a cheaper price, and they get good margins in that environment. But if you expect gold and energy to go up together, some of those royalty companies are very interesting because they're basically kind of a free claim on long-term appreciation. Just the caveat is that investors have to be able to put up with those higher valuations and expect that to pay out.
And unfortunately, for a lot of the mining companies, when the gold and silver prices do go up, so do all the other expenses eventually, all the other mining costs. So we have high energy costs right now, and the cost to build a mine is up. But if the gold price were to say to go to $2,500 an ounce in the next 2 or 3 years, maybe even sooner than that, if things go totally bonkers, then you could also have mining costs start to rapidly rise as well, even faster than they are now.
Yeah, I mean, if you had an environment of 2,500 gold, but then you had oil at 150, that for some miners would be better than others. But yeah, basically you'd have expenses and revenue doing well at these companies. Whereas the royalty companies, that's just pure margin. And so an investor just has to make sure they have a view on both the the revenue side and the expense side for any company that they're analyzing. And so I think for a lot of investors, just directly holding gold is a great way to have exposure. And then to the extent that they want to go out on the risk spectrum, they can look at some of the royalty companies, they can look at some of the diversified, mid and larger companies, and that they really have to have a lot of expertise if they want to get into the smaller companies.
So I'm looking at the companies that some of these well-respected investors with long track records of success, like Warren Buffett, Stanley Druckenmiller, David Einhorn. David Einhorn did an excellent presentation that he released on his Twitter in the last week or so. And he's a traditional value investor. And he disclosed that he's buying oil pipeline companies. He's buying oil and natural gas companies. He's buying base metal miners. He talked about adding exposure to gold, and he thinks gold's going to have a big rally. So do you think then, based on the actions of like these well-known investors that are buying mining stocks for the first time, and oil and natural gas stocks are buying them big, they're selling their other positions, do you think consumer staple companies, because of stagflation and taxes, they're going to be cutting dividends soon, and commodity producers, these low-cost miners and commodity producers, pipeline companies, they're going to be raising dividends? So we're going to kind of have the opposite of what a normal value investor would expect with these traditional consumer businesses, where they generate free cash flow, they have higher profit margins, and they raise dividends. Kind of the opposite is happening right now with a reverse wealth effect.
I think so. And if you look at that industry, it's still very underowned, right? So, maybe in the very near term, some of those oil companies and commodity companies got ahead of themselves. There's a lot of kind of fast money went in there pretty quickly. But I think that, as we get even any sort of mild correction, that remains a very interesting space long term, because you still don't see large pools of capital over allocated. Some of them, due to ESG mandates or other decisions, they're just not allocating at all. And there's not exactly a lot of retail enthusiasm for them either, right? So there's been some hedge fund exposure to it, but they're not over-owned in many ways. And if you look at, I mean, it's interesting you bring up energy pipelines, because I've been looking at that a lot in recent years. It's been one of my bullish areas. Because there's really not a lot of fast money in there. So pipelines had two big rounds of getting utterly wiped out. So the whole 2014, 2015 oil price decline, A lot of them were basically doing Ponzi economics where they were just constantly issuing debt and equity. And so, and it was pretty reliant on high valuations. And so when you had, even though their underlying operations were not heavily affected in some cases by the reduction in oil and gas prices, their financials were. They basically just couldn't find aggressive buyers for their stuff anymore. And because they were so levered and so reliant on constantly issuing, they had to cut distributions. They had to sell some assets. Kind of the famous one was Kinder Morgan blowing up. Um, and then some of the ones that survived that then ran into problems during 2020 when that whole industry got hit again. And so by now you've had a really big washout in that space. A lot of it's delevered. A lot of it is just more sustainable types of financing, and especially for the ones that still issue K1 forms, like the actual MLPs, the ones that have not converted into corporations, there's really no fast money in them because it's kind of an added form during tax season. A lot of people avoid that, so you generally get a little bit of a valuation discount. And so for investors that are interested in like 3 to 5 year exposures to these high yielding, kind of asset heavy hard asset type of investments, I do think they offer better, risk adjusted return opportunities than what we see in the broad market. But then I also think energy producers, and I think you have to watch out for areas of excess. So for example, it was in mid 2020, I invested in some copper companies, and I expected to hold them for 3 to 5 years, but then within like 6 months they just soared. Basically, the whole world, there was the whole reopening trade, and people were piling into copper in particular, and so it got really frothy from my view. And I ended up exiting that position, and of course it went up higher than I would have guessed, but then it came back down, and so that's something I'd like to eventually get back into. Especially if you start to see another upturn. Right now, when you have a declining economic environment, copper can be pretty challenging. Generally, gold is better than copper when you have a decelerating global economy. And so right now I prefer gold. But in whatever the next upturn is, when I start to see signs of that, copper would be another area that I'd be interested in getting hopefully longer duration exposure to.
And fertilizer companies are not exactly sexy either, and their input costs are a lot of natural gas and other energy inputs. But Lyn, I don't see how we're going to plant more crops. I don't see how crop yields are going to go up without more investment by farmers into better farm equipment and into more fertilizer.
Yeah, I've been a long-term holder in Nutrien. That's been one of my holdings for a while now. I considered trimming it when it had that blow off top, and I didn't really get out of it. So it's had somewhat of a correction now. I think it's let off some of the steam and it's back down to somewhat more reasonable levels. And so that's another diversified type of exposure I like to have for this whole space. I think this is going to be a decade of commodities, and I'm trying to do mostly a broad approach with my commodity exposures, and just kind of tilting away from whatever is getting excessive at certain periods. They start to go vertical and everyone's talking about it. That's where I might either trim or just not keep adding for a period of time. But I think that, especially on corrections, I do think fertilizer companies, I think there's a lot of interesting things out there in the whole space, and that some of the increases we've seen recently are probably, just the beginning when you look back, say 5+ years from now, just with the caveat that I do think it's going to be a pretty volatile ride for some of these.
Oh, yeah, I agree with the volatility. I think that's the thing that the average investor or trader who's listening to this interview is not going to understand, that they've been chasing these potash stocks for the last 6 months, 8 months. They were chasing them all the way up, and now they're coming down. But a smarter investor was waiting for them to come down, was waiting for capital. They're looking on the charts for maybe a consolidation, correction and consolidation, for it to base for a little bit, maybe 6 months. I interviewed Dr. Mark Faber a couple weeks ago. He said the next 6 months, probably fertilizer stocks will bottom. These companies their profit margins, their costs are going up with natural gas, but their profit margins are still solid. A lot of farmers did not order fertilizer the last year or two. They bet that fertilizer prices were going to come down. And now you're going to probably start to see some more orders from the farmers who skipped out on some of the planting season because the demand for food is there. I think food and energy, and we've highlighted this at the beginning of the interview as we wrap things up here, I don't think the problems in food and energy, the supply side problems, the scarcity, I don't think they're going away. I think this is a long-term trend. If it's a long-term trend, it's probably a bull market, and it's probably investable if you do not buy all of your position at once, which is a very common mistake among a lot of investors these days.
Yeah, I think this will be a trend that gives a lot of entry points, and that you want to have an exposure to what you think makes sense, but then continue adding potential rebalancing on periods of weakness and pullback. Um, and I think that this bull market in commodities ends when you start to see a lot of supply come online. And so right now we started to see a price response, but we've still not really seen a supply response for most commodities. Around the margins, some of them are getting announcements for supplies coming online, but for the most part, there's not a rush of new supply yet. Some of this just takes a lot of time, and some of them just don't have a lot of incentive to do it right away. And so I think that a few years from now, several years from now, when you start to get a ton of capital just building out new types of supply, that's when you might want to start thinking about longer term exits. But right now, I still think we might have gotten over the first wave of commodity excitement. Some of the froth is getting out, some of the copper froth is getting out, some of the fertilizer froth is getting out. We saw a little bit of a correction in energy recently. So I think that some of that froth comes out, but that's when I would personally, especially if we're looking out a couple quarters, if we're in a significant recession, some of those more cyclical commodities I think could be on sale again, and I would look to probably reallocate to some of those.
And sentiment wise for the commodities, I mean, silver, I think, is one of the most hated. It's underperformed the other commodities by a lot. The sentiment for gold is very, very negative for US and Canadian investors. But gold prices have not crashed, unlike some of these other asset prices. So gold has kind of done its job. Despite a lot of people criticizing it, it hasn't crashed 20, 30, 40, 50% like some of these technology stocks, some of these altcoins.
Yeah, I like Incrementum's approach. So Incrementum is that fund in Europe, and
Money.
yes, exactly, and he well, and it's a number of them, and they invest in gold miners and stuff, but they also have like a fund that's like it's mostly gold, but then also has some Bitcoin in it, and they basically rebalance. So they benefit from the volatility of Bitcoin, and the stability of gold together. And so if investors only holding one, they had some pretty disappointing periods over the past few years where they would expect gold to be rallying and it's not, and instead Bitcoin's going up 10x, and then there's Bitcoin's getting utterly slaughtered down 70%, and gold's just trying to kind of chopping along and holding its value. Whereas if someone has a decent chunk of gold and say a little chunk of Bitcoin, they rebalance it or they buy each one when they're kind of out of favor, which is what Incrementum's fund was doing. That's a pretty smart approach. Basically, it's like diversifying among the types of scarce monies. And so generally Bitcoin historically does very, very well in rising PMI environments. So the risk on, liquidity is flowing into the market. Bitcoin does well, and then you get bubbles in all these altcoins. And then most of them never get past another cycle. Usually Bitcoin does so far. We don't know the future. Whereas gold generally shines relative to other assets in more risk-off type environments, declining PMI environments, liquidity getting soaked up. And so I think that for an investor that wants exposure, some of those communities fight with each other. I like both in different allocations, along with all these other commodity exposures, and along with some of the infrastructure like pipelines and things like that.
So last question before I let you go, and I've really enjoyed this discussion. We're a little over an hour. What are some ways people can beat or at least keep up with inflation in their portfolio or grow their incomes outside the stock market?
So I actually think one of the things I've been mentioning in the past several months when we started to get signs of food crisis was basically investors making sure that they have allocations to food and supplies in their own home if possible. Because I think that you know, when you're in like this kind of risk-off environment, it's funny because this year we've had this raging inflation, and cash has been one of the best investments to hold because most things have just gone down. So gold did okay, cash did okay, even though it's getting devalued. Whereas stocks are down, bonds are down, real estate's running into headwinds. But another cash-like investment that someone can do is just stock up on supplies, because as we all saw in 2020 during lockdowns, supply chains are not very resilient. Things can disappear from shelves, and it's designed for just-in-time, delivery and kind of lean manufacturing and lean supply chains. So I think it's really up to households to have some sort of stock, some sort of buffer against periods of shortages, and things like that. And so I can't really imagine a scenario where storing some non-perishable food and storing some supplies, paper products over a few years, doesn't do better than inflation, or at least keep up with inflation. That doesn't mean, build a bomb shelter and be a full-on prepper, but I think that it's just responsible for people and households, to the extent that they have room and that they have some extra funds, to make sure that their own kind of situation is secure as possible in terms of the things that they need on a regular basis.
I've kind of talked about this for a while now. So if people bought like a used refrigerator and freezer, especially like a used freezer on Craigslist, and then they set it up in their garage or somewhere else, they could have then vacuum sealed their meat, their protein, their steaks. They could have bought it 18 months ago, and then their protein costs would have been locked in. So they would have had meat available for their family, themselves and their family, at a much cheaper price, because the cost of protein is up enormously, many different proteins.
Yeah, I think a basket of beef, chicken, fish, and eggs is up like 14% year over year, and that's the official number. Many obviously individual cuts are up way, way more than that. And so I think that's a good example of having nutrient dense foods stored away. And then you've chronicled a lot the whole shrinkflation trend. Basically, there's a lot of inflation in consumer products, just basic simple things like paper towels or laundry detergent, things like that. I think basically just having more than the immediate supply of things that you use is both good for security in general, and I think it's just one of the best risk-adjusted return things that someone can do if they want to allocate to something outside of the stock market, just to have a buffer for a lot of these goods that they use on a regular basis.
But something important with investments, though, are the rules changes. So unfortunately, people want an easy solution to difficult problems. Lyn, you've spent over an hour with me discussing all the difficult problems that these governments and central banks are trying to pull levers on. And in a lot of cases, they're making them worse. And then they're going to keep changing the rules. So the average person, they ask me about different investments or asset classes. Well, what are the rules going to be next week or next month? The rules are going to keep changing, unfortunately. And this is the type of new normal that we're in right now.
I think that's why diversification is important to some degree. That doesn't mean to own everything, but it means to know that there's a lot of things you can't know, partially because the world's very complex, and also partially because, as you point out, rules can change. And so I think that that's why some degree of diversification makes sense. So instead of focusing on one commodity, I want to focus on several and be able to focus on whatever's kind of out of favor or cheap at the moment or at the right part of the cycle. Because rules can change on multiple things in the space. Same thing for other assets. And so I do think that knowing what you don't know is going to be a key, part of success this decade.
And as we wrap up here, all in on Bitcoin, all in on gold or silver, all in on rental properties, all in on technology stocks, all in on dividend stocks, these consumer staple dividend stocks that we just highlighted. The smarter investors are now lightening their portfolio of and moving into commodities. Shockingly, these are traditional value investors. So all in on anything in this type of environment, very, very dangerous.
I agree.
So Lyn, if my listeners want to sign up for your free newsletter or pay newsletters, how do they do so?
So I'm at LynAlden.com. Like you said, I have free and paid. I'm also on Twitter at Lyn Alden Contact. So the most of my content's pretty free, so people can check that out.